let's hop into some DCF stuff.
I was just about to say that. Lead us off with the first stock here, Daniel.
All right, so I am going to show everyone. Oh, wait, how do I do this? Let me do this. I'm going to put this over here. And then I'm going to do this. Boom. You guys can see I'm rating our subscribers.
I was going to say, there's a little sneak peek there.
The subscribers only newsletter that's going to be sent out later today. If you want it, you got to be a subscriber to Stock and Lock.
So from the perspective of a newer investor, Daniel, what flow do you walk through and what would bring you to this type of tool? What kind of questions are you looking to answer with this?
Okay, so this is our discounted cash flow calculator, DCF for short. This is basically a tool that a lot of, I think not very many beginner investors use this. And to be honest, when I was a beginner investor, I did not use a DCF calculator. I still don't use this as like the holy grail of investing, or, you know, like if I run a DCF and it says that a stock is undervalued, I'm not going to be like, okay, I'm buying it today. You know, it's a part of the analysis, not the full analysis for me. And I use it to try and put things in perspective to understand how a stock is valued today. So that's one thing that I actually do with the DCF is I try to understand what is currently being priced into the stock right now. And then I ask myself, like, is that too optimistic? Is it pessimistic? And then is there an opportunity there, or should I be avoiding it? So we're going to take a look at Apple first, because you know what? I'm not going to give you my opinion. I'm just going to show you what I think. So
what?
That may have been worded stupid. I'm sorry. Anyway.
No, it's this is all what live show is all about.
Yeah.
I was going to say just one quick thing for the newbies here who don't know how to approach this. I think one thing you really need to understand is earning multiples. So that I think would be the dependency on really understanding these tools. Learn about price to earnings ratios, because this is a forward projection. And thank you for letting me do that quick interruption. Which one are we going to look at here, Daniel?
Okay, so for Apple, I like to look at the free cash flow, and I'm going to use 10 years. I like to have a little bit longer of a time frame. So what our discounted cash flow calculator is going to do is you can select the metric you want to use. We have a couple of videos on our Stock on the Lock YouTube channel going through when I believe you should use earnings, free cash flow, operating cash flow, all of it. Those are very in-depth videos if you want to know what metric to focus on. So with Apple, I believe free cash flow is the best. Again, I want to project out 10 years. And what we do here, we automatically do the autofill. You can turn that off. But over the past 10 years, Apple has grown its free cash flow at an annual rate of 8.63%. So basically, our DCF will take this and then just project it out over the next 10 years. So what it does is it makes the assumption that Apple is going to grow over the next 10 years as quickly as it did over the past 10 years. That's the best we could do. I don't know if you want to believe in that or not, but I think that this is actually a little bit too optimistic in Apple's case. I think that they're probably going to grow at like 5% or 6%. Let's be optimistic. Let's say 6%.
Yeah, and one call out on this, especially for newer users, the autofill is a very great feature in Stock and Lock, since it will seed values that our software, just looking at past financials, think are sane. However, it's definitely up to the user to really understand what's going in here, since the price that's going to be output that Daniel's driving us to is very dependent on your input. So this is not a real estimate or any kind of guarantee. It is the investor putting in what they think will happen to the business. And based on how it's traded historically, if the stock does grow, you can create some reasonable theses around, okay, this stock might actually be worth X in the future based on how it's grown in the past. But yes, very good point there, that it is a little dangerous to just take those at face value and not understand them. So it's worth turning on education mode for new users. And we got question marks in the video to walk you guys all through it.
Yeah. And then the next thing is the shares outstanding growth rate. They've bought back about 4.7% of their shares outstanding annually. They're probably going to continue doing that in the future, so I'll leave that. Price ratio over the past 10 years on average has been 16. I'll just leave that. And a 10% discount rate is basically the rate of return that we want. So basically saying over the next 10 years, if Apple can grow free cash flow at 6%, buy back about 4.7% of their shares, and trade in line with their historical average price to free cash flow, then the stock's fair value is $111, or 32%, basically 33% if you want to round up, below where the stock is currently trading. So this stock today, based on these estimates, will not give you a 10% annual return. It will give you about a 6% annual return. Sorry, my cat just walked in. So basically,
Tuna.
basically what I'm trying to say is I think that Apple has just become a little bit expensive in the market. If we actually go and take a look, go to Freeform. I just want to show everyone Apple's price to free cash flow and what it's been doing recently. Oops, price to free cash flow. Because now it's trading around 27, which is well above its historical averages. As you can see, it's like actually near the high end. And Apple's revenue is even, it's been kind of stagnant for almost a year now, and it's actually starting to come down a little bit. So I think that, you know, a 27 price to free cash flow for a business where the revenue isn't really growing anymore, at least for right now, is quite expensive, which is why, you know, yeah, that's why I wanted to run it through the DCF and kind of just show my thinking, because I think the market is pricing in for quite a bit of growth.
Can we scroll down the page a little bit? And I found that interesting too. So you went to the free form to try to validate your assumption. And some people might be looking at this who are on video and say, wow, this looks like Apple stock price is going to 2x. However, do you believe that that's where their free cash flow will be at in 10 years? Because that's the assumption that this calculator is making. And going back to the freeform tool, Daniel, I think that's a really great strategy to look influence for how to put these numbers in. You go to their financials and really try to look at their product, see where they're innovating, and not that we can predict the future, but use our best educated guess as to where those will be in the future.
Yeah,
So
and
what
then
if we take that down to like 2% growth rate? What would that do to the fair value?
one thing first, what I like to do in the DCF, what I just did is changed the growth rate to find out about where the fair value is. So you can see for Apple to be fair value right now, it would basically have to grow its free cash flow at 10.2% to give you that 10% return, which would mean its free cash flow would have to 2.5x over the next decade, which I don't know if it can do. I really don't know. So basically, yeah, I would look at this then and say, I think that this is too optimistic. And this is what the market is currently pricing. So I think that this is too optimistic for me, which means that, you know, I could come to the conclusion that maybe it's not an investment that I would necessarily be happy buying right now. But that's just me. I don't know if Apple's going to outperform or not, but yeah, that's just kind of my opinion on it.
Yeah, I mean, we can go into a whole on Apple. I am just not a consumer of Apple products, and I know you aren't either, so we might have a pretty unfair conversation about it. But they've obviously built a dynasty, and it seems like the world's running on iPhone, or at least half of it. So got to give credit where credit's due. But will they continue that in the future? I don't think so.
Yeah. Actually, this was another one I wanted to do, Jake. Let me know if you want to run through one, but someone just asked, what would be the fair value of Equitable Bank? And could you show another example maybe for Microsoft?
Yeah, thank you so much for that suggestion. Let's do it. I've got one, but we've got time. I think we have about 13 minutes until Stock Auto is coming on. Pronounced it correctly that time.
Thank you. Yeah, okay. So we've already explained the freeform tool now, so I am just going to run through really quick. So with Equitable Bank, this is a bank. So I like to use the earnings number. Now, again, we have the autofill on, so this is all of Equitable Bank's just numbers over the past decade. I like to be a little bit conservative whenever I'm doing these, so I actually don't think Equitable Bank is going to grow at about 13%. I'm going to be a little bit more conservative, just say 10%. Shares outstanding growth rate, I'm going to leave that the same. Price ratio, leave that the same. Actually, no, the price ratio, I think that over time it's going to expand and they're going to be more in line with other banks. So I think it's actually going to expand to about 10.
And this is a great mindset too, right? I mean, as other investors go and use these tools, these are the exact questions you should be asking yourself.
Yeah. Also, this isn't the best right now because Equitable Bank had some major one-time charges related to an acquisition. So their earnings is actually down right now. But anyways,
we can override the last metric, which is a feature that a user actually asked for that we added a month or two ago.
Yeah, I don't have the number on the top of my head, though.
Got you.
So, yeah, maybe I should do that, honestly. Let's do Microsoft because this isn't going to give an accurate picture. Because I don't have
you are not a shareholder of Microsoft, correct? Because I am.
I am not a shareholder of Microsoft. Microsoft, I would use free cash flow. All right, so let's just take a look at their autofill metrics. So this is just projecting the past 10 years out. And this says metric growth rate of free cash flow about 9%. Buying back shares, yep. price to free cash flow ratio of 23, 10% discount rate. Sorry, 10%. And that says fair value is 31.5% below where it's currently trading and about $196. So based on Microsoft's historical, their last 10 years, if they do that again and they grow at about 9% over the next 10 years annually, then the stock looks like it is actually expensive. So what would they need to do? Let's do 13%. 13.5. Okay.
If we scroll down, what would that bring the total value to at the end of 10 years?
Yeah, I'll take a look at that. But cool. Basically, Microsoft right now is priced as if it's going to grow its free cash flow by 13.5% a year over the next decade, which would end up being $211 billion in free cash flow. They did about 60 billion in the trailing 12 months. So they would have to basically more than triple free cash flow over the next decade to just be fair value today.
That looks like an aggressive assumption. Not that we can predict the future. I mean, that would be great. I'm a shareholder. I'm looking at that. I'm like, if Microsoft does that, I mean, I'd be a monkey's uncle. That is an incredible amount of growth on an already very large base. So
yeah, and the thing about Microsoft too, like this is also giving it a 23 price to free cash flow, which is a little bit more on the rich end. So I don't know, like if we go back to our freeform tool and we take a look at Microsoft here, it's kind of been doing the same thing as Apple, where its price ratios have just continued going up and up and up for quite some time. Like it's basically just been continuing to uptrend, and now it's trading for a price to free cash flow of 36. So that, in my opinion, like that's a very expensive multiple, especially on a stock that's like already so big. And yeah, I mean, the market's just pricing Microsoft like it's going to grow its free cash flow very dramatically over the next decade. And, you know, like if they don't hit this, then, you know, the stock's probably not going to deliver amazing returns. Yeah, so basically, I just think the market's pricing it for, it's just being very optimistic on Microsoft, in my opinion.
Yeah, we have a good comment in the chat here from Ali. Also, this member of Stock and Lock is the person who is helping us out with the podcast. So shout out to you. Thank you so much. AI wars are at play. And Daniel, my comment was going to be not that I'm speaking for us, but just looking at the stock price. It seems that people are pricing in or giving Microsoft a higher multiple because of their place in AI. Yes, this is very speculative. And as you mentioned, that is adding more risk to the stock, especially when people start thinking of margin and safety and things like that. You can kind of see this is a very well talked about stock. And it seems like people are pricing that in. Maybe they'll be right, but you know, look where others aren't is what a lot of other people would say. I personally was buying this at around 225. My average is 223. Not financial advice. I'm just kind of watching it at this point. I do those all for long-term holds, no intentions on selling. Great company. But yeah, it's definitely flying pretty high with all the AI craze going on.
Yeah, it's just pricing in a lot of growth already. It's basically like even if Microsoft does grow free cash flow by 14% per year over the next decade, like it's already pricing that in basically.
Definitely. And I'm going to share my screen here and just walk us through my stock. Many of you know I'm very bullish on Airbnb. I have continued to do a lot of research, especially on the short selling reports and things like that. I will bite my tongue because I do love having my bull rants about them, but just keeping it to the, oh, it looks like I'm logged in on a guest account. Just keeping it to this DCF. So Airbnb, obviously they sell rental properties. This company has around a 40%, I forgot the exact number, free cash flow margin. So they are extremely profitable on the revenue that they break in. Daniel, I know you said 10 years. I'm just going to throw in some more opinions here because I think it's up to the investor of how to use this. I feel a little bit more comfortable with 5. There's no right or wrong here. For me, I think 5 is a little bit easier to just kind of like stomach and feel confident about. I think 10 years is very hard to predict.
Yeah,
however, yeah, and again, no right or wrong there. So what I like to do with Airbnb is I like to value them on free cash flow since they are profitable. They have positive free cash flow. I personally think this company is going to continue to grow very rapidly. So I am putting in a 15% growth rate. I think 37 price ratio is a little bit high. So I'm actually going to lower this down to 30. This is still very high. I understand that. We were just looking at Apple and Microsoft, and we both agreed, hey, 27 is high. However, I'm going to use the Amazon argument here that when you have a business that has such a huge moat and is growing as quickly as Airbnb, my opinion, which I know you might disagree with Daniel, is that this company will continue to command a high earnings ratio based on their growth rate and their amazing leadership. one thing I love to focus on too is this does seem very sane to me. So for those of you who are just on audio, we are looking at, well, if we project their future growth rate by 15% for 5 years on their free cash flow, which was reported as 3.41 billion in the last trailing 12 months, that would bring us all the way up to 6.85 billion in 2028. I think that's very possible. Just my opinion, not financial advice. So, we've been running through these numbers a lot, but these are the tools I like to use when thinking about long-term stock prices. This is obviously a big bull case. I think you should do your own research, and there are people who disagree with me here, but these are one of the reasons why I love Airbnb. And as they make more money, I continue to see them having very, very high free cash flow margins and being a very profitable business. So any comments here on Airbnb, Daniel? Any fun arguing you want to have about this one?
I think those are pretty optimistic numbers.
Yeah, that's the side I'm taking on this. I'm very bullish on Airbnb, and that's what makes investing fun. I do know we did have some comments on the last stream. I just want to let everyone know Daniel and I are super close friends. If anything comes off as like a little bantery, I mean, that's just how we are and our personality, but rest assured that, we are both very happy and feeling good about things. I can also definitely make sure I'm standing up for myself if I feel that Daniel ever crossed the line. But Daniel, I don't think you ever do. I genuinely love when we disagree on things. I think it's a lot more fun than when we agree, personally.
Yeah, I just got to stop bullying you. Anyways, all right. So while Jake was going through Airbnb, I went to Equitable Bank's most recent earnings report for the full year of 2022. I found their adjusted net income rate here of $326 million. Again, they did an acquisition in 2022, which they had a lot of one-time expenses. Personally, I'm happy to remove those because, again, I think that they're one-time expenses. So this is like what the bank would have done without the acquisition costs. So going forward, this is probably what they're going to more likely produce in the future. So what we can do over here on our DCF tool is add in the most recent metric override. So if there is some adjustments you want to make to the numbers, you can enter in the number that you essentially want. And that's what I'm going to do here for Equitable Bank. So now I'm going to drop that growth rate back down to 10%. I'm going to say price ratio expansion to roughly a 10 price to earnings ratio, 10% discount rate. That's the return rate I want. And we can see here that the fair value is about $71 a share with these assumptions here. Future stock price will be 210% above, and the compounded annual growth rate will be about 12%. Now, one thing that our DCF does not do that we want to build is show the dividends as well, because Equitable Bank does pay about a 2.3% dividend today, and that should be added to the compounded annual growth rate and fair value. So in the future, we will have dividends, hopefully. Don't know when that will come, but yeah, that will give a more accurate representation of the earnings. And then based on these estimates right here of 10% earnings growth, that means the bank will be producing about $846 million of earnings by 2033 relative to 326 today. I don't think that this is like super unrealistic. I think they can probably do this, to be honest. And if they do, then I mean, the stock looks pretty cheap.
This is when I say I think that's extremely optimistic, friend, but that is what makes investing fun.
Yeah, we'll see.
Yeah. And for those of you watching, one great thing about Stock and Lock is you are looking at 2 out of 3 founders here. That metric override was a direct ask in our Discord from a user who wanted to be able to override that. And as Daniel said, we have a lot more in the pipeline with dividends coming through. So whether you're just in your free trial or you're already a subscriber, please reach out to us on our free Discord email. We are very excited to just make sure we're building things based on your guys' feedback. And quite honestly, do believe that it is one of the best investing tools on the market for retail investors today. Of course, I'm opinionated.